day, guys. Join me today in reading this very important trading book. It's one of the books I found very treasurable in my trading journey. In the course of the reading, we'll be taking some important trades when we get to the point we need it. Yes, and we'll add some technical indicators that will even make the strategies and the price actions here very efficient. I bet you, if you follow me in the course of this till the end of this book, you'll be a powerful trader. Thank you. We start with the introduction. The Candlestick Trading Bible is one of the most powerful trading systems in history. It was invented by Homer Monisha, the father of candlestick chart patterns. This trader is considered to be the most successful trader in history. He was known as the god of markets in his days. His discovery made him more than $10 billion in today's dollar. I've spent 10 years compiling, texting, organizing, and consistently updating this method to create my own new version, which is considered to be the easiest and most profitable trading system. The Candlestick Trading Bible is the trading method that is going to finally take your trading to where it should be: consistent, profitable, easy, and requiring very little time and effort. This trading system is based on Japanese candlestick patterns in combination with technical analysis. All what you have to do is to spend as much time as you can to master the methods, and I am going to share with you and use it to trade any financial market. Learning Japanese candlestick is like learning a new language. Imagine you got a book which is written in a foreign language. You look at the pages, but you get nothing from what is written. The same thing when it comes to financial markets. If you don't know how to read Japanese candlesticks, you will never be able to trade the market. Japanese candlesticks are the language of financial markets. If you get the skill of reading charts, you will understand what the market is telling you, and you'll be able to make the right decisions in the right time. The easy-to-follow strategy detailed in this book will provide you with the profit-making techniques that can be quickly learned. More importantly, learning the principle of market psychology underlying the candlestick methodology will change your overall trading cycle forever. The Candlestick Trading Bible has already proven itself. Fortunes have been made using the Japanese candlestick strategies. I congratulate you on taking the first step in your trading education. You're on the right path to become a better trader. However, this is actually just the beginning of your trading career. After finishing this book, the real work begins. Don't read this book very fast. This is not a novel. You should take your time to understand all the concepts I discussed. Take your notes and go back from time to time to review the strategies I shared with you. Remember, this is an educational work that will teach you professional method and how to make money trading financial markets. If you got the skill that I share with you here, it will change completely your life and the life of people around you. Let's go over to the overview. The ebook is divided into the following sections: Number 1, candlestick anatomy. Just as humans, candlesticks have different body sizes. And when it comes to trading, it's important to check out the bodies of candlesticks and understand the psychology behind it. That's what you learn in this section. Number 2, candlestick patterns. Candlestick patterns are an integral part of technical analysis. Candlestick patterns emerge because human actions and reactions are patterned and constantly repeated. In this section, you will learn how to recognize the most important candlestick pattern, the psychology behind this formation, and what do they indicate when they form in the market. Number 3, the market structure. 4, time frame and top-down analysis. Number 5, trading strategies and tactics. We continue with why candlesticks are important to your trading analysis. Candlesticks are important to your trading analysis because it is considered as a visual representation of what's going on in the market. By looking at candlesticks, we can get valuable information about the open, high, low, and the close of price, which will give us an idea about the price movement. Candlesticks are flexible. They can be used alone or in combination with technical analysis tools such as the moving averages and the momentum oscillators. They can be used also with methods such as Doe theory or Elliott wave theory. I personally use candlesticks with support and resistance, trend lines, and other technical tools that you will discover in the next chapter. The human behavior in relation to money is always dominated by fear, greed, and hope. Candlestick analysis will help us understand these changing psychological factors by showing us how buyers and sellers interact with each other. Candlesticks provide more valuable information than bar charts. Using them is a win-win situation because you can get all the trading signals that bar charts generate with the added clarity and additional signals generated by candlesticks. Candlesticks are used by most professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. You can take your money easily if you don't understand the game. Even if you can trade $100,000 trading account, you can't move the market. You can't control what's going on in the market. Using candlestick patterns will help you understand what the big boys are doing. And we show you when they enter and when they exit and when they stay away from the market. We move down to what candlestick is. What is candlesticks? Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. As you can see in the picture, if the close is above the open, we can say that the candlestick is bullish, which means that the market is rising in this period of time. Bullish candlesticks are always displayed as white candlesticks. In our today's charts, you see it as green candlestick. You can as well change it in your MetaTrader if you choose to. The most trading platform use white color. In our today's what I've said is green to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. The most important is to the open price and the close price. If the close price is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks. In our today's charts in MetaTrader, you see them as red candlesticks. You can as well change them. So we continue. Candlesticks have different body sizes. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during this period of time. Conversely, if there is a bearish candlestick in which the open is above the close with a long body, this means that the selling pressure controls the market during this chosen time frame. Short and small bodies indicate a little buying or selling activities. The upper and lower shadows give us important information about the trading section. Upper shadow signifies the section high. Lower shadows signify the section low. Candlesticks with long shadows shows that trading action occurred well past the open and close. Japanese candlesticks with short shadows indicates that most of the trading section was confined near the open and close. If a candlestick has a long upper shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. But for one reason or another, sellers came in and drove price back down to end the section back near its open price. If a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers flashed their watchbird apps and forced price lower. But for one reason or another, buyer came in and drove prices back up to end the section back near its open price. Candlestick patterns. Candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setups. Research has confirmed that candlestick patterns have a high predictive value and can produce positive results. I personally trade candlestick pattern for more than 20 years. I can't really switch to another method because I tried thousands of strategies and trading methods with no result. I'm not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is a part of this game. If you're looking for a 100% winning system, I highly recommend you to stop trading and go look for another business. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the language. How could you live if you can't even say a word? It's tough, right? The same thing when it comes to trading. If you know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trade behavior. This skill We help you better enter and exit the market in the right time. In other words, this will help you act differently in the market and make money following the smart guy's footprints. The candlestick patterns that I am going to show you here are the most important patterns that you will find in the market. In this chapter, I am not going to show you how to trade them because this will be explained in detail in the next chapter. What I want you to do is to focus on the anatomy of the pattern and psychology behind its formation, because this will help you get the skill of identifying easily any pattern you find in the market and understand what it tells you to do next. The engulfing bar candlestick pattern. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle. But to be considered as an engulfing bar, at least one candle must be fully consumed. The bearish engulfing is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. See the illustration below. Can you see it? This is how a bearish engulfing bar pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. In case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. See the example below. Can you see the bearish engulfing bar? As you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you'll find on your chart. You will need other technical tools to confirm your entries. We'll talk about these in details in the next chapter. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you find. Then we move over to the bullish engulfing bar patterns. The bullish engulfing bar consists of two candlesticks. The first one is the small body, and the second one is the engulfing candle. See the illustration. The bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation button. See the example below. The example above shows us clearly how the market changes direction after the formation of a bullish engulfing bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What's important is that smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price action setup alone, because you will need other factors of confluence to decide whether the pattern is worth trading or not. I will talk about this in the next chapter. What I want to do now is to get a skill of identifying bearish and bullish engulfing bar on your charts. This is the most important step for the moment. The doji candlestick pattern. The doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. See the example below. As you can see, the opening price is the same as the closing price. This signal means that the market don't decide which direction we take. When this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. See another example to learn more. The chart above shows how the market changed direction from the first formation of doji candlestick. The market was trending up. That means the buyers were in control of the market. The formation of the doji candlestick indicates that buyers are unable to keep price higher, and sellers pushed prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves higher or lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing its strength. So if you are already riding that trend, it's time to take profit. It can also be used as an entry signal if it's combined with other technical analysis. The dragonfly doji pattern. The dragonfly doji is a bullish candlestick pattern which is formed when the open high and close are the same or about the same. What characterizes dragonfly doji is the long lower tail that shows the resistance of buyers and the attempts to push the market up. See the example below. The illustration above shows us a perfect dragonfly doji. The long lower tail suggests that the forces of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a dragonfly doji. In the charts above, the market was testing the previous support level that caused a strong rejection from this area. The formation of dragonfly doji with a long lower tail shows us that there is a high buying pressure in the area. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located. When it occurs in a downtrend, is interpreted as a bullish reversal signal. But as I always say, you can't trade candlestick pattern alone. You will need other indicators and tools to determine high probability dragonfly doji signal in the market. The gravestone doji. The gravestone doji is the bearish version of the dragonfly doji. It is formed when the open and the close are the same or about the same price. What differentiates the gravestone doji from the dragonfly doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. See below. The image above illustrates a perfect gravestone doji. This pattern indicates that while buyers were able to push prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. See another illustration below. The chart above shows a gravestone doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. As a trader, you will need additional information about the placement and context of the gravestone doji to interpret the signal effectively. This is what I will teach you in the next chapter. The morning star. The morning star pattern is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend, and it consists of 3 candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. The second candle is a small one, which represents that sellers are in control, but they don't push the market much lower, and this candle can be bullish or bearish. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The morning star pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of the downtrend near support level, it is interpreted as a powerful trend reversal signal. The chart above helps us to identify the morning star pattern and how it is significant in the formation at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. The second candle could be a doji or any other candle. But here the doji candle indicates that sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control from sellers, and the market is likely to reverse. This is how professional traders analyze the market based on candlestick pattern, and this is how you will analyze financial markets if you master the anatomy of candlestick pattern and the psychology behind the formation. The evening star pattern. The evening star pattern is considered as a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern consists of 3 candlesticks. The first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be doji. It can be a doji or any other candlestick. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. The third candle is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star pattern. See example below. The first part of the evening star is a bullish candle. This means that bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that buyers' domination is over and a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal signal. As you can see, the market was trending up. The first candle in the pattern indicates a long move up. The second one is a short candle indicating price consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gaping lower than the previous candlestick, indicating a confirmation of reversal at the beginning of a new trend down. The hammer, you can as well call it pin bar. The hammer candlestick is created when the open high and close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. See illustration below. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lower price. As you can see, the market was trending down. The formation of the hammer or pin bar was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but in that level, sellers were trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which results in a trend reversal. The most important to understand in this psychology behind the formation of this pattern, if you can understand how and why it was created, you will be able to predict the market direction with high accuracy. We'll talk about that, how to trade this pattern and how to filter this signal in the next chapter. The shooting star, the bearish pin bar. This bearish pin bar formation is formed when the open low and close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is the bearish version of the hammer. Professional technicians say that the shadow should be twice the length of the body. See the example? The illustration above shows us a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal pattern, bearish reversal signal. The psychology behind the formation of this pattern is that buyers tried to push the market higher, but they got rejected by a selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. See the example. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend move and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand area, and with technical indicators. The shooting star is very easy to understand and is very profitable. It is one of the most powerful signals that I use to enter the market. The Harami pattern, or rather the inside bar. The Harami pattern is considered as a reversal and continuation pattern, and it consists of two candlesticks. The first candle is the large candle. It is called the mother candle, followed by a smaller candle which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. This candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend. It is a bullish signal when it occurs at the bottom of a downtrend. See the example? As you see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with the color. The most important thing is that the smaller body closes inside of the first bigger candle. The Harami candle tells us that the market is an indecision period. In other words, the market is consolidating. So, buyers and sellers don't know what to do, and there is no one in the control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it occurs at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. See the example here. In the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly, price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that buyers' domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. We study in detail how to trade this pattern, either a reversal pattern or a continuation pattern, in the next chapter. The twists, tops, and bottoms. The twist top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezers bottom formation is interpreted as bullish reversal pattern seen at the bottom of a downtrend. The tweezers top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezers bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish candlestick. So we can say that the tweezers bottom is the bullish version of the tweezers top. The tweezers top occurs during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up, but sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezers bottom happens during a downtrend when sellers push the market lower. We feel that everything is going all right, but the next section price closes above or roughly at the same price of the first. The bearish candle, which indicates that buyers are coming to the reverse of the market direction. If this price action happens near support level, it indicates that a bearish reversal is likely to happen. The chart above shows us a tweezers bottom that occurs in a downtrend. The bears push the market downwards on the first section. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal, but signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of a candlestick. Try to understand the psychology behind its formation. This is the most important. Because if you can understand why it was formed, you understand what happened in the market, and you can easily predict the future movement of the price. Candlestick pattern exercise. Now I think you can get some information about Japanese candlestick. You know the anatomy of each candlestick and the psychology behind its formation? Let's take this exercise to test your knowledge and see if you still remember all of the candlestick we've talked about. Look at the chart below and try to find the name of each of the candlestick number and the psychology behind its formation. If you can easily identify these candlestick patterns and you understand why they are formed, you're on the right path. But if you still struggle to identify them, you will have to start learning about them again till you feel like you master them. Let's try to answer the questions concerning candlestick patterns on the charts above. Bullish harami pattern, inside bar. The formation of this candlestick pattern indicates indecision in the market. In other words, the market was consolidating during this session. Bullish tweezers. The market was trading up. Sellers tried to push the market lower, but reaction of buyers was more powerful. This pattern represents battle between sellers and buyers to take control of the market. Engulfing bar. Sellers were engulfed by buyers. This indicates that buyers are still willing to push the market higher. Engulfing bar. Harami pattern. This pattern shows us that the market enters in a consolidation phase during this section. So buyers and sellers are in an indecision period, and no one knows who is going to be in control of the market. Let's take another exercise and look at the chart below and try to figure out these candlestick patterns. The bullish engulfing bar, hammer, which is large body plus small body, Harami pattern. Bullish engulfing bar. Please, I want you to open your charts and do this homework over and over again. You will see that with screen time and practice, you will be able to look at the charts and understand what the candlestick tell you about the market. Don't worry about how to enter and exit the market for the moment. Take your time and try to master the candlestick patterns discussed in the previous chapters. In the next chapter, I will arm you with techniques that will help you identify the best entry and exit point based on candlestick pattern in the combination with technical analysis. Trust me, these price action strategies will turn you from a beginner trader into a profitable price action trader. Next is the market structure. We've added live charts to make it more interesting. It's a very, very important lecture. Don't miss it. And then don't forget to subscribe to this our YouTube channel. Thank you.